Alphabet just made history with a $32 billion borrowing spree here. That's why it matters, the biggest tech debt sale you've never heard of. In less than 24 hours this week, Google's parent company Alphabet pulled off something extraordinary. They raised nearly $32 billion through bond sales across multiple currencies. And buried in that massive haul is a financial instrument we rarely see anymore, a 100-year bond. Yes, you read that right. Alphabet is borrowing money that won't need to be fully repaid until 2125. To put that in perspective, the last time a tech company issued century-long debt was Motorola back in 1997, when most of us were still using dial-up internet. Breaking down the numbers, let's start with Monday's US dollar offering. Alphabet initially planned to raise $15 billion, but ended up pulling in $20 billion after receiving over $100 billion in orders from eager investors. That's one of the largest order books ever recorded for a corporate bond sale. The demand was so intense that Alphabet decided to supersize the deal. They split it across 7 different tranches with varying maturity dates, giving investors options ranging from short-term to long-term commitments. Then, on Tuesday, Alphabet made its debut in both the British, sterling, and Swiss franc markets, including that historic 100-year sterling bond. Combined with Monday's sale, they raised the full $32 billion in under 24 hours. So why is Alphabet borrowing all this money? Here's where it gets interesting. Alphabet is planning to spend between $175 billion and $185 billion in capital expenditures next year, alone roughly double what they spent last year. Nearly all of that money is going toward one thing: artificial intelligence infrastructure. We're talking about massive data centers, thousands of servers, specialized AI chips, and the physical backbone needed to power services like Gemini, Google Search's AI features, and their cloud computing platform. Building the AI of tomorrow doesn't come cheap. The AI arms race is expensive. Alphabet isn't alone in this borrowing binge. According to Morgan Stanley, the big cloud providers, often called hyperscalers, are expected to borrow around $400 billion in 2026. That's more than double the $170 billion borrowed last year, and nearly 10 times the $44 billion borrowed in 2024. Oracle recently raised $25 billion through bonds in early February. Meta sold $30 billion worth of bonds last October. The pattern is clear. Tech giants are leveraging their strong credit ratings and investor confidence to fund an unprecedented infrastructure build-out. Why investors are eating this up? You might wonder why investors are so eager to lend money to these companies. After all, $100 billion in orders for a $20 billion bond sale means there was 5 times more demand than available bonds. The answer is simple: safety and stability. Alphabet and other tech giants have fortress-like balance sheets, consistent cash flow, and businesses that print money. In an uncertain economic environment, lending to Google's parent company for steady returns looks pretty attractive compared to riskier alternatives. That 100-year bond is particularly fascinating. Investors who buy it are essentially betting that Alphabet will still be around and thriving a century from now, long after everyone reading this is gone. It's a vote of confidence in the staying power of big tech. What this means for the future? This massive borrowing spree tells us several things. First, the AI race is intensifying and companies are willing to take on significant debt to compete. Second, the infrastructure requirements for AI are staggering. We're talking investments that dwarf anything we've seen in tech before. Third, despite concerns about tech valuations and market conditions, investors still have enormous faith in these companies' ability to generate returns over the long haul. The question now is whether all this spending will pay off. Will the AI services these companies are building justify the massive infrastructure investments? Only time will tell. But one thing is certain: the tech giants are betting big, and they're using cheap debt to do it.